Have you ever watched a 6-year-old peddle homemade chewing gum to neighborhood kids, or counted the coins he'd saved from newspaper routes with the same reverence most adults reserve for investment portfolios? That was young Warren Buffett, wide-eyed and magnetized by the thrill of turning spare change into profit. While other children hunted baseball cards, he scoured the Wall Street Journal for undervalued stocks and studied price-to-earnings ratios as if they were secret maps to hidden treasure. Even before his voice cracked, Buffett understood that money wasn't just cash, it was power waiting to be unlocked by patience and insight. He didn't stumble onto this truth. He built it piece by piece, dollar by dollar. Whether he was hawking used golf balls or hand-delivering Coca-Cola bottles for a penny apiece, Buffett saw every venture as a mini laboratory in compounding. He learned early that a single dollar invested wisely could grow into hundreds, then thousands, simply by staying put and reinvesting its earnings. While speculators danced to the beat of daily market swings, he embraced the counterintuitive wisdom that time, not timing, was the ultimate ally in wealth creation. Buffett's childhood also unfolded against the backdrop of the waning Great Depression, where frugality wasn't a choice but a necessity. He watched neighbors patch leaky roofs and repurpose every scrap of fabric, internalizing the discipline of living below one's means. This mindset became his invisible armor. He refused to borrow for luxuries, chose second-hand desks over flashy offices, and measured every expense against its opportunity cost. Each penny saved was another seed planted in his mushrooming snowball of capital. These early chapters weren't quaint anecdotes, but the blueprint for a lifetime of extraordinary decisions. They reveal how a relentless curiosity about value, a fierce respect for compounding, and an almost monastic discipline in spending forged the man who would become the Oracle of Omaha. As you journey deeper into the Snowball, keep this vivid image in mind. A boy with a calculator clutched in hand, eyes gleaming at each perfect spreadsheet, a portrait of ambition, humility, and the boundless potential of compound interest. Long before he earned the nickname Oracle of Omaha, Buffett was already applying his childhood lessons in compounding to real markets. At age 11, he plowed his paper route earnings into 3 shares of City Service Preferred. He watched their price dip, panicked, and sold only to see them rebound sharply. Undeterred, he later repurchased and held them through another cycle, pocketing a modest but exhilarating profit. This early encounter taught him 2 vital truths. First, that markets can be irrationally volatile in the short term. And second, that a long-term perspective could transform volatility into opportunity. He began tracking every purchase and sale in a notebook, analyzing what worked and what didn't, essentially creating his own personal investing laboratory. As Buffett prepared for college, he discovered Benjamin Graham's seminal text, The Intelligent Investor, and was captivated by its rigorous approach to valuing businesses. Graham's philosophy of buying securities at prices significantly below their intrinsic value resonated deeply with Buffett's own budding instincts. He enrolled at Columbia Business School specifically to study under Graham, absorbing lessons on margin of safety, risk aversion, and the discipline of detachment from market sentiment. Under Graham's mentorship, Buffett learned to view stocks not as ticker symbols on a screen, but as fractional ownership in real businesses complete with assets, liabilities, and long-term earnings potential. Buoyed by this newfound rigor, Buffett returned to Omaha in 1956 and launched Buffett Partnership Limited, pooling capital from family and friends. He scoured undervalued companies, focusing not on flashy growth stories, but on firms with predictable earnings, strong balance sheets, and competent management trading at bargain prices. When the market tilted toward speculative technology or bloated valuations, Buffett doubled down on disciplined value plays, often buying when others were fleeing. Over the next decade, his partnerships generated annualized returns north of 20%, cementing his reputation as an investor who could consistently outperform the broader market by sticking to his principles. Buffett's evolution accelerated further when he encountered Charlie Munger, a lawyer with a voracious appetite for multidisciplinary knowledge. Munger introduced Buffett to the power of investing in high-quality businesses with durable competitive advantages beyond the strictly cheap companies Graham favored. This partnership melded Buffett's deep value orientation with Munger's insistence on structural moats, strong brands, and exceptional management teams. Together, they shifted focus from purely quantitative bargains to qualitative excellence, paving the way for acquisitions like See's Candies and eventually the transformation of a struggling textile mill, Berkshire Hathaway, into the globally diversified holding company we know today. This melding of philosophies set the stage for Buffett's lifelong strategy. Marry rigorous valuation with enduring business quality, and then let compounding do the heavy lifting. As Berkshire Hathaway evolved from Buffett's ownership of a struggling textile mill into the investment vehicle it is today, Buffett's philosophy matured in parallel. In the early 1960s, recognizing that the capital demands of the textile business severely limited his ability to seize new opportunities, he began deploying excess cash into delightful businesses with predictable economics, starting with insurance companies. The acquisition of National Indemnity in 1967 gave Buffett access to float, the pool of premium dollars held before claims payouts, effectively providing a low-cost source of investable capital. This strategic pivot illustrated his skill at identifying not only undervalued assets, but also innovative structures that amplified compounding by reinvesting insurance float into high-quality equities. Insurance float soon became Berkshire's engine, and Buffett used it to acquire entire companies rather than just small positions. He targeted firms characterized by durable competitive moats, businesses like See's Candies, whose strong brand allowed for pricing power, and Geico, whose direct-to-consumer model delivered both growth and float. Buffett structured these deals to ensure managers retained autonomy with generous incentives, trusting them to run their operations while he provided capital allocation expertise. This combination of decentralized management and disciplined oversight created a collection of businesses that generated reliable cash flows and reinvestment opportunities, compounding at rates Buffett could scarcely achieve through public markets alone. Alongside these acquisitions, Buffett's annual letters to Berkshire Hathaway shareholders became must-read manifestos on investing and life philosophy. He distilled complex ideas into pithy, relatable language, warning against leverage, extolling patience, and emphasizing integrity. He introduced the concept of Mr. Market, an imaginary partner whose emotional volatility offered buying and selling opportunities to the rational investor. These letters transcended mere financial reporting. They shaped a culture of long-term thinking, ethical leadership, and intellectual honesty, both within Berkshire and across the broader investment community. Readers internalized Buffett's rule. Focus on the quality of businesses, the character of management, and the intrinsic value beneath fluctuating market prices. By the 1990s, Berkshire's market capitalization had soared, but Buffett's personal habits remained remarkably frugal. He continued living in the same Omaha house he purchased in 1958, flying coach as long as possible, and eating at modest local diners. His disciplined personal lifestyle mirrored the conservative risk profile he demanded from his investments. Even as Berkshire acquired blue-chip brands like Dairy Queen, Fruit of the Loom, and Benjamin Moore, Buffett insisted on resisting the temptation to overpay or chase the latest fad. His unwavering commitment to value and counsel to be fearful when others are greedy and greedy when others are fearful guided both shareholders and his own decades-long odyssey from small-town entrepreneur to one of the world's most revered investors. Beyond savvy acquisitions, Buffett's edge lay in his unwavering commitment to operate within his circle of competence. He repeatedly emphasized that no matter how tempting a complex industry might appear, he would rather wager small in a domain he fully understood than gamble big on unfamiliar terrain. This discipline guided Berkshire away from cutting-edge tech trends and into simple, time-tested businesses: consumer goods, railroads, utility networks. By focusing on enterprises whose economics he could model confidently predictable cash flows, strong brands, stable demand, Buffett minimized unknown risks. He famously quipped that risk comes from not knowing what you're doing. Sticking to clear, comprehensible business models enabled him to allocate capital with near-surgical precision and sleep peacefully through market storms. In the 2000s, as Berkshire's portfolio shifted toward colossal investments, like the landmark $26 billion acquisition of BNSF Railway, Buffett applied the same patience and clarity. He recognized that owning one of North America's largest freight networks aligned perfectly with his criteria: exceptional barriers to entry, essential service nature, and revenue streams tied to economic growth rather than fickle fads. Though critics warned that such scale could dilute his nimbleness, Buffett remained undeterred, viewing railroads as the arteries of commerce. By integrating this mega acquisition, he demonstrated that even gargantuan deals could conform to his circle of competence ethos: large-scale roads running on well-understood rails. Simultaneously, Buffett's role evolved into that of a master capital allocator. He likened himself to a financial supermarket, deciding each quarter which of Berkshire's operating businesses, equities, or cash reserves would deliver the highest compounded returns. This meant sometimes selling outright stakes in once-cherished companies when prices exceeded intrinsic values, eschewing ego in favor of discipline. His 2018 shakeup, trimming positions in major banks and selling down IBM, underscored his willingness to admit errors and redeploy capital where prospects seemed brighter. This dynamic repositioning exemplified Buffett's principle: when an opportunity within your competence offers a better yield, don't hesitate to shift, even if it means crossing emotional lines. Yet, perhaps the most profound evolution of Buffett's philosophy unfolded outside the boardroom, in his approach to philanthropy and succession. In 2006, he pledged to give away more than 99% of his wealth, and he structured plans for Berkshire's stewardship beyond his lifetime. Rather than leaving the empire to heirs, he entrusted the reins to trusted lieutenants, most notably Greg Abel and Ajit Jain, whose proven stewardship of Berkshire's energy and insurance divisions mirrored Buffett's own disciplined judgment. This transition plan reflected his belief that the principles underlying his success, integrity, long-term focus, and rigorous valuation could transcend any single individual. By institutionalizing these values, Buffett ensured that the snowball he'd painstakingly built would continue growing, rolling out new chapters in the business of life for generations to come. One of Buffett's most enduring lessons is the power of reputation, a form of social capital that compounds over a lifetime. Long before Berkshire's immense scale, Buffett understood that his word and handshake were his most valuable currencies. He famously structured partnership agreements in the 1950s on a simple napkin, trusting that integrity would enforce performance far more reliably than legal minutiae. This principle carried through Berkshire's growth. When Buffett lauded a manager's competence or a business's prospects, the market listened, and his endorsements carried weight. By placing honesty and reliability at the core of his dealings, Buffett built a legacy that attracted partners, investors, and acquisitions eager to align with his rock-solid reputation. Closely tied to reputation is the concept of margin of safety, a buffer that guards against unforeseen volatility. Buffett credits this Graham-inspired tenet for preserving and growing capital through market crashes, economic downturns, and industry disruptions. Whether negotiating the purchase price of a textile mill or valuing a privately owned utility, he insisted on buying well below estimated intrinsic worth, ensuring that even worst-case scenarios left room for gains. This disciplined insistence on a cushion against error not only protected Berkshire from ruin, but enabled aggressive acquisitions when panic forced competitors to sell at fire sale prices. The margin of safety thus functions as both shield and sword, defense in turbulent times and leverage when opportunity knocks. Buffett's personal life underscores the importance of balancing ambition with humility and relationships. Despite amassing immense wealth, he has lived in the same modest Omaha home since 1958, valuing stability and community over ostentation. His enduring marriage to Susan Buffett, marked by mutual respect and intellectual partnership, provided emotional grounding throughout decades of relentless business activity. He credits Susan's counsel for many of his best decisions, illustrating that even the greatest investors benefit from trusted confidants. This fusion of personal and professional wisdom reveals that wealth's true value lies not in possessions, but in nurturing relationships that sustain us through market highs and life's inevitable lows. Finally, Buffett's journey teaches that learning is a lifelong endeavor. He devotes 5 to 6 hours each day to reading annual reports, biographies, and industry analyses, accumulating a compendium of mental models from psychology to engineering. His voracious appetite for knowledge, from Isaac Newton's laws to Charlie Munger's multidisciplinary frameworks, fuels his investment insights and his reflections on life. By modeling continuous curiosity and intellectual rigor, Buffett reminds us that success isn't a fixed destination, but an evolving trajectory. In the business of life, The true snowball effect occurs when we relentlessly expand our understanding, refine our judgments, and apply timeless principles across every sphere. Finance, ethics, relationships, and personal growth. At the heart of Buffett's legacy lies his profound commitment to philanthropy, a recognition that true wealth transcends personal accumulation. In 2006, he stunned the world by pledging more than 99% of his Berkshire shares to charitable foundations, primarily the Gates Foundation. This decision reflected his belief that capital, if left dormant in family trusts, fails to address urgent societal needs. Instead, by directing future gains toward healthcare, education, and poverty alleviation, Buffett ensured that the compounding of capital would serve a higher purpose. His approach to giving mirrors his investment philosophy. Apply rigorous analysis to identify where donations can achieve the greatest long-term impact. Then trust in the process to unfold with patience and integrity. Buffett's philanthropic framework emphasizes strategic, outcome-driven support rather than indiscriminate generosity. He advocates for significant contributions to a small number of well-run organizations with proven leadership and measurable results. This targeted focus mirrors the way he selects Berkshire's operating companies seeking exceptional management, sustainable business models, and clear performance metrics. By applying the same value investing principles to philanthropy, competitive moats of social impact, rather than market share, Buffett has inspired a new generation of donors to think like investors in the social sector, leveraging capital for maximum human benefit over time. Looking beyond finance and charity, Buffett's life exemplifies the broader business of life. He underscores the importance of joy and balance, a private passion for bridge, a love of simple home-cooked meals, and deep friendships that endure beyond boardroom board games. He teaches that success measured solely by net worth is hollow, unless paired with curiosity, kindness, and a sense of humor. His annual shareholder letters often veer into reflections on happiness, marriage, and the folly of chasing status symbols, reminding us that compounding applies as much to relationships and personal fulfillment as it does to dollars and cents. Ultimately, the Snowball tells a story of continuity, how principles honed in childhood ventures blossomed into a life of extraordinary influence, wealth, and generosity. Buffett's journey from calculating stock prices in a small-town newspaper office to stewarding one of the world's largest conglomerates is underpinned by timeless tenets. Embrace patience, live within your means, invest in quality, guard your reputation fiercely, and give back with strategic intent. As we close this series, carry forward the lessons of compounding not only in your portfolios, but in your character, your relationships, and your contributions to the world. In the grand tapestry of life, every small decision, like every invested dollar, multiplies, creating snowballs of value, impact, and purpose that roll far beyond our own lifetimes.